In many ways, successful investing is relatively straightforward. For many clients, particularly younger ones, much can be gained by simply choosing a portfolio with an allocation to growth assets and holding those investments for a long period of time and benefiting from the wonders of compound interest. Now, despite that being simple, it isn't necessarily easy, of course. As advisors will be aware, markets go through large cycles, and as they do, clients' decision-making and behaviours can go through cycles with them. So as markets go up, there can be periods of euphoria, excitement, risk-taking, but then as markets go down again, we have periods of the opposite, so anxiety, conservatism, and potentially selling investments and switching to cash. So given this, what can advisors do? Well, one approach, of course, is to reduce the risk of clients being impacted by these cycles by reducing the risk profile of their investments, reducing the allocation to growth assets, for example. Now, of course, this can reduce their risk profile, but comes with the drawback of also reducing their expected returns as well. So what else can they do? Well, that's what this module is designed to answer. So what we're going to do is we're going to look at some of the psychological drivers of clients' decision-making through market cycles. And much of that is related to emotions, of course, and we're going to talk about that in a little bit of detail. But there's much more than emotions. So we're going to talk also about, for example, the impact of how clients mentally account for their gains and losses through market cycles, how they find patterns in the noise and can over-respond to those, how they're influenced by social dynamics of what other people are doing and saying at the time, and how they can be influenced by the sort of simple mental shortcuts and decision-making rules that they can apply to maybe cut through some complexity and make sense of what's going on. So we're going to look at some of the psychology behind each of those dynamics and then say, well, how can an advisor use insights from psychology to better engage and influence their clients through market cycles? And the idea being that doing so can lead to better outcomes for the clients, higher returns, lower risks, but also reduce costs and taxes potentially along the way as well. And also for the advisor, how can it make the advisor's life a little easier, less frustrating in working with clients through what can be quite a difficult period?